Hey everyone, Eric here. Wanted to do a video on gamma scalping. And the reason is I hear a lot of people talking about it, which is cool. It's an interesting concept. But I do think that it would be helpful to kind of level set on some of the ideas and basis for it so that we can kind of understand whether or not it makes sense for retail traders to gamma scalp. So let's jump over and dig right in. In a nutshell, gamma scalping is the idea where we have a derivative position and we use the underlying, whether it's long stock, short stock, to negate the effect of theta. So the cost to carry a long options position. And notice how I mentioned that the cost to carry a long options position. I say that because in general, gamma scalping is focused more on a long options position, not saying it's exclusive. There is inverse or reverse gamma scalping, whatever you want to call it. But obviously the circumstance changes a little bit where when we buy an option, theta is working against us. We're paying theta. Whereas if you sell an option, theta is actually working for you. So the heart and soul of gamma scalping doesn't really apply to short options positions, but you can still apply the concept. So it's a close neighbor, and like most trading terms, it's all bullshit because everybody has their own version of what means what. So that's just kind of an overview of gamma scalping. And then kind of the two houses or camps you can fall into, whether it's long options or short options. And then for those that need a super quick refresher, gamma, that's the rate of change of delta for every point move in an underlying. And then delta is the rate of change of premium in a specific option for every point move in the underlying. So you can tell that they have a relationship with one another. Whenever delta is moving, gamma is moving. It's going to tell us how much delta should be changing based on the current circumstances. All right, so before going into the general setup, let's just talk very quick base set. Gamma scalping in general is an institutional practice. And there's a very specific reason for that. It's becoming more accessible to retail traders because of the commission battles, but it still is advantageous for institutions, moreover, as compared to retail traders. A lot of times I think a lot of retail traders just don't like risk, and they try to implement more complex strategies like this. And realistically, once you include commissions, it can really not do too much for you. Now, this is different now because most brokerages allow you to trade the underlying for free. And that's really what this is all about. So that's really helpful as retail traders look to employ more institutional practices. All right, so let's get into the setup. I'm not going to go into an example on this one to keep the video a little bit lighter. I'll let this kind of digest for everybody, and then we'll do a follow-up to work through a couple examples. So this is what it normally looks like. Like I said, it's going to be a long premium trade. It doesn't have to be, but for the base of, if we're going to talk about gamma scalping in a pure form, this is where we'll start. And as you know, the movements in the underlying and delta, they're positively correlated. So as an underlying goes up in price, delta goes up in price, and then the same thing if the underlying goes down. So what happens is most times we're going to start with some sort of straddle. So we'll have a long call and a long put that are delta neutral, meaning they're similar deltas, ideally the same, not always practical, so that there's very, very low delta. So that if the underlying moves up, we would expect those positions to essentially offset one another. So when we have the underlying moving up, we would want to add short stock. So if we have our straddle on right now, there's no delta. And let's say we see a significant move up in the underlying, and now our position is starting to take a different shape because as the market moves, we're going to see the Greeks for those long calls and long puts change a little bit. So the more that the underlying goes up, our position is going to have a increasingly bullish bias, meaning that those long deltas are going to overwhelm the short deltas in that trade. So the idea is in that scenario, you would add short stock to rebalance your deltas. So as soon as your deltas start to get outside of whatever range you have set to keep it delta neutral, as soon as it hits that, then you would add short stock. And the idea here is that if it continues up, then your underlying options position would still continue to profit in excess of the added short stock. Not always the case once we start adding in changes in volatility, but again, for just a theoretical conversation, that's the idea. And then as the underlying starts to drop, you would remove those short stock, take a profit, and then if the underlying continues to move down further, that's when you would do kind of the inverse. You would add long stock to offset your now short deltas. So realistically, a lot of people think the idea of gamma scalping is to make a bunch of money on top of the straddle, and that's not really the goal. The idea is to negate theta in the option. So obviously, if you're at the money straddle, for example, you're going to have a lot more theta. And we want to try to mitigate that via gamma scalping, but you're not going to make an entire new bundle of profit by gamma scalping in excess of your theta and your straddle. The real scenario here for most people is to essentially cover the cost of theta and then have a free straddle that hopefully moves in your favor, that sort of thing. Now, the other note that I'll leave the video off with is that you need the underlying to move. If you have an underlying, when we're long a straddle, that position does well when there's a breakout one way or the other. We want the underlying to move in a big way up or down. If you have a long straddle and the market is just chopping along sideways, gamma scalping becomes next to impossible because there's no moves for you to successfully trade between because your deltas aren't moving at all. So a lot of people will try to kind of prematurely start gamma scalping, in my opinion at least, and it doesn't really lead to any profit. It actually starts to negatively cause drag on the overall position. But again, that's not to say that depending on circumstance, that in a smaller, tighter market, that if you had great timing, that you would be able to adjust with the underlying. It just becomes more difficult with smaller moves because one of the biggest indicators for you to add stock or remove stock is when your deltas start to get unbalanced. When does that happen? When there's a move in the underlying. So ideally, we would have kind of bigger moves up and down so that you can gamma scalp on both sides and then continue to maintain a delta neutral trade while negating your theta. That doesn't always work, obviously. And sometimes you might get something that starts to move up and just blows past you. And there's kind of another approach to managing that, which we'll get into in the follow-on video. But the idea here is that you need movement. If there's no movement in the underlying, gamma scalping doesn't really do you a whole lot of good. So that is Gamma Scalping 101. I hope that wasn't too heavy. I tried to keep it a little on the lighter side just to, not scare people off. It's one of those things that sounds really complex, but it's not. And it's also one of those things that a lot of people bastardize. And I talk about that with trading all the time because it can be super confusing for people. So until next time, we'll get into an example. But if you have any questions, let me know. Happy to work through any of those in the meantime, and I will talk to y'all later.